Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, how's it going this week?
Good, Derek. How you doing?
Not bad. Just got back from a little work trip down in Phoenix. It was hot there, and it's cold here. So,
Yeah, it really took that turn where now we're waking up. It's like middle of October right now, and it's like there's frost on the grass. And
yeah,
still.
there's
What
enough.
was it? What was it in Phoenix? You said it was like, what
Yeah,
was it?
96 in Phoenix during the day. Yeah.
Yeah. So
31 this morning. Like it was like crunchy frost. And I was taking the dogs out.
Yeah, yeah. And the leaves are starting to dwindle, which is unfortunate, but yeah, I told my wife on the way back from the airport, I was like, man, the leaves already look a little more dull than they were 3 or 4 days ago. So
Yep. It's a fact.
winter is upon us, but nonetheless, we continue on. Guys, this week we are officially wrapping up Nelson Nash's book, Becoming Your Own Banker. This is going to be at least the last dedicated episode to the material that Nelson covers in the book. There are going to be other topics that we will discuss in the future that are adjacent to it or can maybe provide a little bit more clarity and in-depth information about some of the concepts that Nelson was trying to demonstrate for us in the book. But we've come to the tail end. This is it, folks. This is the summary of everything that Nelson was trying to teach us throughout the book. And so, guys, we've got a number of points to consider here for ourselves and for our audience. The first one is where Nelson says that there are only two sources of income. It's either active income or passive income. And for those of us that have a dedicated W-2 job, if you're a salaried employee in that way, that's considered active income. What do you guys consider as passive income? Or what does the IRS maybe even consider as passive income?
Well, first thing it reminds me of, have you guys read The Richest Man in Babylon yet?
You know, I ashamedly have not actually read that book, but I know so much about it because of the space that we play in, but I haven't actually read that one yet.
But he talks about your little gold workers. You know, you're putting them to work and then they make more workers and they make more workers. So that's what came to my mind thinking about passive income. You're putting your money to work and it's growing while you're sleeping, while you're awake. I mean, that's the best place to be putting your money. Put it to work.
Right. So some places that just generally where people see as a passive income would be real estate as a source of passive income. That's a very popular play. But real estate's broad. It could be timber, like Nelson invested in as a forester. Could be farmland. It could be multifamily. It could be single family. Could be RV parks. You know, you name it. But generally speaking, the income that is derived from a real estate investment is classified as passive income. John, what are your thoughts on some maybe other passive income plays out there?
yeah, my thoughts are that the word passive, I think, has some shades to it. Like it's not necessarily you are doing zero work.
Right.
There are avenues, and I think life insurance is one of the few that literally just by default it's going to grow, guaranteed. Like it's not going to go down.
Right.
There are very few avenues that are purely passive. I have a couple friends actually who run payments processing companies, and all they do is onboard clients. They service the payment machines that actually like receive the credit card swipes, and every swipe they get a quarter. every swipe, like, that's purely passive where they're sleeping and say a restaurant's going till late at night, they're still getting money, as income. So, that's what I consider purely passive, is truly you don't have to lift a thumb and there's money coming in.
Right.
I do see real estate as the semi-passive, where you're actively involved with probably like tenants or, repairs, dealing with all sorts of different variables that comes with real estate. But I love whole life insurance for the reason that it's just for those who are lazy. I had someone else talking to last week. He's like, if I wanted to be just totally lazy, like, is this a good way to go forward? Like, actually, it's one of the few ways where it's guaranteed, where you do nothing and it'll continue to grow. So just continue in your day job and it'll all work out, I promise.
Right.
So, and it's funny actually that one person, here's a quick aside, is now that he sees more opportunities available, the idea that, opportunity finds capital, he's like, well, actually, maybe I don't want to be that lazy. Maybe I could use this cash value for X, Y, or Z. So I love how the infinite banking concept opens people's mind. But back to passive income. Yeah, no, I just wholeheartedly believe that there is nothing else like, whole life that'll provide truly that passive income.
Right. And one of the pieces that goes with whole life insurance is the dividend. So dividend income is also classified as passive, largely speaking. So if you're receiving dividends in your stock portfolio, if you're receiving dividends from a privately held company, those are considered more passive type income. Let's move on, guys, to point number 2. Nelson says, if you knew at passive income time or retirement age that you would be getting back everything that you paid into a system tax-free, would you object to putting more money in it?
Nope.
If you had a guarantee to get every dollar back that you have contributed to your retirement planning, would you object to putting more dollars there?
No. As a matter of fact, I want to put as much of my dollars in a place that I'm guaranteed to get it all back. Plus, well, I went, especially 30 years from now, when that same amount of money is giving me multiples back of what I put into it. Yeah. No, that's a no-brainer.
Yeah, it truly is. And a question I get fairly often is, what's the cost of this?
Right.
And then I have to step back and think, okay, what does he mean by cost? And so then I just take the initiative to define my understanding of the cost of whole life insurance. Basically, it's zero. All right. And my understanding of cost is dollars that you do not see ever again. It's an expense. It's something that leaves your system, never returns, or you never end up having access to.
Yeah.
But not a single dollar that you put into a whole life policy will you ever actually lose, will ever actually leave your system.
Right.
Sure, you may lose upfront, slight liquidity, but say you're, pass away early, say you're to get disabled, like you're protected in such a way that all the dollars that you're putting in, on top of the cash value, this is like in addition, will be there for you or for your family, right? So man, I would want every dollar to not be lost. The word disposable income just makes me cringe. Like, who wants to dispose of their hard-earned money? I think of the same with disposable time. Like, time and money are so valuable, but yet we use these phrases like disposable income and time that, oh, well, yeah, I can throw that away for whatever it may be. Like, if you're just a little bit more thoughtful and understood the sequence of where your money goes, that you can never actually have to dispose that money or lose those dollars or have it be a sunk cost. Again, how many of those dollars would you want to put into this?
Yeah, don't you think that's like a missing piece that people just don't understand? Like, they think that permanent life insurance is like term life. Like term life, it's a cost. It costs you X amount of money. If you don't die, that money is gone. I think people associate term and permanent whole life as the same thing, where it's not. The money you're putting into a permanent whole life policy, like you said, John, you have access to all of that plus multiples more over time. And so that's what we're here to do. We're here to educate people. Term is an important component at phases of your life. It's an important component. It's complementary to whole life, to make sure you're taking care of your family. But it is like you're renting it. It has a cost and it disappears. That God forbid you pass away, then there's a benefit to term, but otherwise that's a cost that doesn't go. That's gone. It's sunk. But whole life, you'll recoup all of that you put into it, and we just have to educate people of that. That's why it's such a powerful, product and powerful system.
Which actually dovetails very nicely into our next point, where Nelson then says your wealth must reside somewhere. So you need to ask yourself, where do you want your wealth residing? He gives 3 examples: real estate, the stock market, or permanent whole life insurance as the warehouse of your wealth, the place where it goes first, where you store it and then utilize it. So let's just analyze those 3 options there. I mean, we've talked about real estate already in this show, but why is real estate a difficult place to store wealth?
It's not liquid.
Explain that for us, Rob. What do you mean by it?
So if you put your money into real estate, the money goes into purchasing real estate. Mm-hmm. And if you need to get that money out, you can't just pick up the phone and say, I need $10,000. You have to go to a bank and you have to get a line of credit and you have to jump through all these hoops. And that takes time. And you might just not even be allowed to do it. They might just say no. So there's no guarantee you can get the money that you put into the real estate.
Yeah.
It's not liquid.
Yeah, especially, I mean, think about right now the homes in North Carolina or Florida or Wyoming where they've had wildfires. If your property burns down or gets destroyed in somehow, even if you had $200,000 worth of equity in that property, doesn't matter. The bank's not going to give you a loan.
Nope.
Not when it's been damaged like that. Even if you have roof damage, right? I mean, there are certain things that the banks will just not lend against if your building is not up to code or, repairs need to be made or you've got damage like we've already discussed. They're going to shut the doors to you and say good riddance because we are not going to take on that risk to give you access to capital loan against your property, even if you have that equity. And so then in that case, you're generally forced to sell in order to try to get some access to that equity in the form of liquid cash.
Yeah.
But in doing that, you've probably given up some of your equity because you're now having to sell at a discount.
Yep.
And so that's where being a real estate investor can be a risky proposition. And, is maybe not the best first place to store your wealth.
Don't you think, I would say a vast majority of people, they consider their home is their wealth, their warehouse of wealth, the equity in their home.
Yeah.
I think that's just such a wake-up call for any of our listeners, watchers, that I think primarily most people's wealth is the equity in their home. I would probably say that's risky. I mean, a tornado comes through or a hurricane comes through, flood comes through, and all that equity you're kind of counting on as your emergency, as your safety net, it can be just gone like that. Put it into a place that's permanent, that can't be destroyed. That's why we love permanent whole life.
And it's based on the value of the home, which we all know is super volatile. I feel like it's so strange to me that people have already forgotten so quickly what happened in 2008 and 2009. That was a very real thing for so many people. But yet, because the market bounced back, it it generally does bounce back. But when people needed cash the most likely during the 0809, they had lots of their wealth locked up in these homes that crashed just so significantly. Banks weren't giving HELOCs, like nobody was able to access equity in their home, not to mention the value in their homes probably cut in half.
Yeah. Well, not even going as drastically to 2008, 2009. We looked at our home values on Zillow, which is not gospel. It's not perfect, but we looked at the estimated home value of Zillow about a year and a half ago and compared it to today, and we're about 10 to maybe 15% less than just a year and a half ago on what our current market value is for our home. Now, Zillow doesn't know that we've done things to the house, updated it, of course, but just to see, peak to trough, if we're in the trough right now, 10 to 15% difference in equity value, market value for our home, that's tough to see, like, okay, well, the market's going to determine what the true value of our home is. And so we don't really have much control over that. So it's an illiquid asset. What about the stock market, guys? That's probably the most or second most common place for Americans to be storing their wealth is in the stock market. What do you guys have to say about that?
Risky.
So much. Yeah, there's just zero control. I think again, there's these is it rose-colored glasses or lenses where everything's going to work out, right? Everything, the S&P always grows. Like, there is no guarantee in the stock market. You have no idea what's going on in the board of directors room, boardrooms with these large companies, and they're largely driven quarter by quarter to quarter, and so it's just this constant catch up and stress, and people who've been studying this for 30, 40 years still will never get the stock market predicted correctly, right? And with both real estate and the stock market, we are by no means saying to never touch that.
Right.
Although we have our own preferences, what we're talking about is your wealth has to reside somewhere first, right? It's the sequence that matters. I think real estate is a great opportunity from a position of strength, from your own personal family bank, that you can control the terms, to a better degree, if not the full financing capability, and multiply those returns and multiply, the opportunities for you and your family.
Well, John or Derek, then the next place, tell me why then I shouldn't just put all of my money in a bank, right? I can get to it. So why is that not the best place?
Because it generates a terrible return and it's not your money.
And it's only doing one thing for you, right?
Yeah, it's not. Yeah, I mean, that the sequence, as John has already described, the sequence matters, right? Where you put your money in these different buckets at different periods of time, it's going to determine how many benefits you're really going to capture. And so by utilizing whole life insurance as that warehouse, that initial place, the starting point, we're able to capture more benefits than if we had just done the bank and then to real estate, or just on real estate, or put your money only in the stock market. We're capturing 3, 4, 5 times the amount of benefits compared to the general American consumer. So that's why this is such a powerful place, because we've got way more capability by doing it this way, by sequencing where our dollars go first.
And then also I say, in terms of, like, someone might say, well, I don't do stock market. Well, if you participate in a 401k, you are participating in the stock market. And so that's also a place where vast majority of Americans' wealth is residing in 401ks. There's no guarantee that your money is safe in your 401k. There's no guarantee that when you need it, you'll be able to get it. There's no guarantee that the taxes at that point won't be sky high. I mean, there's just so many unknowns to that being your warehouse of wealth. It's just, something to consider.
And in any other scenario, like the purpose of storing our capital is to eventually probably to use the capital. And in any other scenario, you're reducing the principal, you're reducing what you've actually put in and interrupting the growth. Even if you have a stock that's doing amazing, if you continue to withdraw from it and try to put it back in, and it's just a terrible and inefficient, not to mention the taxes on all the growth, terrible place to store your money in that sense, to try to keep the growth going for as long as possible while still being able to use it. Like we've talked about in so many other episodes, being able to use your capital and in parallel continue that compounding, guaranteed, uninterrupted growth is like no other opportunity out there.
Right. That's actually explains something that many of the ultra wealthy investors do with their stocks or whatever sort of asset. I'm thinking of like the Jeff Bezos, the Elon Musks, the Warren Buffetts of the world, right? When they've got all these assets, take Amazon stock, how much does Jeff Bezos really have there? And what does he do? He takes a loan against his asset to then spend down the loan to finance what he needs in his life.
Mm-hmm.
Because he doesn't want to interrupt the compounding that stock has done for him because of the many reasons that John has just described, the potential tax hit that he might be taking, just the interruption of the growth, any dividends that might have been building up. So in their mind, it's better to take a loan against an asset than it is to liquidate and sell the asset in order to spend those dollars down. Right. And that's exactly what we're trying to do here with infinite banking when it comes to that passive income time. Rather than sell your policy and just take the cash right up front, why not take the policy loan against the cash value that's accumulated and live off those policy loans, retain the asset, the life insurance contract, and allow that to continue to compound and grow for the rest of your life? We are mimicking what the ultra wealthy guys have been doing. We're just changing what the asset type is. Instead of it being Amazon stock, we're doing it with life insurance as the first place. We could be taking loans against paid off real estate, rental real estate, investment real estate as a place to then draw income from. That could certainly be a good play, but there's none of those things that offer the guarantees and flexibility that you would be getting if you did this with whole life insurance instead.
Right.
Guys, let's move on to this last point here that we want to talk about in this episode. Nelson says that you finance everything that you buy. And we've done an episode on this already. If our listeners would like to go back and check the archives, I'm sure they'd be able to pull up an episode where we discuss this concept. You either are paying interest to the bank for a loan, or you're giving up the interest that could be compounding on your dollars if you paid cash for something.
Yep.
Talk to me a little bit about that, guys. What are you seeing the smart play being? Obviously, there's a lot of people that say, no, I'd just rather pay cash. And I still, even from time to time, I have that hesitation of like, do I want to take a policy loan out for this or do I want to pay cash? So talk to us a little bit about what you're doing and why this is a smart play.
I think too many people that I get to talk to discount the importance of understanding the opportunity cost or that interest that you could have otherwise earned, that it truly you could retain 6 and sometimes 7 figures in lost dollars that otherwise would be guaranteed to be lost, that you could earn for the rest of your lifetime with very little change to your lifestyle, if at all, would you want 6 or 7 figures of dollars that otherwise is guaranteed to be lost back into your life? Like, framing it that way, for me at least, helps me understand the gravity of understanding the opportunity cost side of things. And then obviously everybody understands, I think, paying loans and having to repay a bank actual interest. And I don't think we can say this statement enough, that you finance everything you buy, because that's at its core, understanding that every dollar has a weight to it. It's either going up in value or you're losing it. If it's in a checking account earning 0.01%, that dollar you're losing money, due to inflation and and after everything's said and done. So understanding that each dollar is going in a direction. It's not just a stagnant, piece of paper. It's something that is constantly going in one direction or another. So that's financing everything you buy and being able to control that and recapture all that interest that you're otherwise paying or giving up is super, super important.
Absolutely. As Nelson would say in the book, banking is, and the money has to flow, right? So it's not, if it's stagnant, it has to flow. So yeah, you're right, John. It's losing money if it's just sitting there, it's losing money. And if you are, getting loans from banks, it has a cost. It always has a cost, no matter what it's doing.
All right, guys. Well, as we come to the tail end of this episode, John, why don't you close us out and just talk to us, remind us, what are the 5 principles of becoming your own banker? And where could people find out more about Nelson Nash and the type of man that he is?
So in summary, yeah, this book changed my life. I'm so, so thankful to get to help anyone out there who's interested in implementing it with their family or their business. And so if you made it this far, congrats in listening to all the episodes going through the book. So yeah, those 5 principles of IBC, and we hear it all the time in our world as infinite banking practitioners. And so the first one is think long term. I think we've hammered this through so many episodes, and that's just interwoven throughout this whole book. Number 2 is do not be afraid to capitalize. And that's a huge, huge point, right? You really, in any scenario, this is a savings strategy, first and foremost, like to understand the importance of savings, not being afraid to capitalize is vital, right? I always say entering, 25%. If you're able to save 25% of your gross household income, then you are far, far better off than anyone with a similar income or even higher income, most likely.
Right.
So don't be afraid to do that, especially if you're putting it in a vehicle like whole life insurance that's picking up so many other benefits for you and your family. The third is don't steal the peas, right? Be an honest banker, pay back your policy loans, make provisions for that prior to taking those policy loans. Number 4, don't do business with banks, right? Banks are, as we've talked about and we'll continue to talk about, unstable, right? They do fractional reserve lending and all sorts of practices that honestly I would say are unethical at some points and unreliable at the very least, to where if you can control the terms that the bank would otherwise impose on you, why wouldn't you want to control that, right? And the last is rethink your thinking, not just about money, right? This is a lifelong process where, again, it opens your mind and your eyes to seeing things in a different way, right? About career, about your family, and obviously about money. So those are the 5 principles. I think they're very important. It's clear those 5 principles are interwoven through this concept. And Nelson Nash, I think another reason I felt confident or comfortable with the concept and with the book is seeing the parallels to biblical wisdom. Nelson Nash was very outspoken as a Christian man. He passed away in 2019 and lived a life true to his convictions. And, his son-in-law is currently the president of the Nelson Nash Institute and is continuing his legacy. And yeah, Nelson Nash practiced what he preached, and you can learn more about him and the infinite banking concept in addition to our podcast, the Nelson Nash Institute YouTube channel. More specifically, I'd recommend I think it's an hour-long documentary called "This Is Nelson Nash," I believe.
Right.
And again, that really helped me feel comfortable about the concept that it's not a pyramid scheme or some sort of gimmick or multi-level marketing, trap. It's just pure fact and purely just like biblical principles.
Yep.
And we'll have probably future episodes about kind of the biblical nature of understanding money, inheritance, family, and I'm very excited about that.
Yeah.
But seeing that it correlates with the source of this concept in Nelson Nash just brought a lot of comfort and clarity to me, and particularly my wife too, to understand that we are actually moving forward into something that's valuable, meaningful, and true, rather than smoke and mirrors.
Well said.
Well said indeed. Well, guys, thank you again for all your hard work and getting us through the book here. If our listeners are interested in learning more about our show and how we work and how we can help you and your family start your own family banking system, feel free to reach out to us at thefamilybankingshow@gmail.com, and we would love to schedule some time to meet with you. In the future here, now that we've closed out this book, there's going to be some exciting updates to come. So I would encourage our listeners to stay tuned and hang on to your seats, because as John said, we're going to be talking about some exciting biblical concepts, some really in-depth, nerdy economic things for those of you who like that sort of information. But nonetheless, we want to say thank you to our listeners for all your support and the ways that you've encouraged us and keep going with this podcast. And we hope to see you in the next episode. Thanks, guys.
Great. See you guys.
Thanks.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.